All right, let's talk about something that's absolutely critical for any serious investor: how to build a real game plan for when the market inevitably turns against you. Look, this isn't about some magical ability to time the market perfectly. It's about having a tough, professional grade strategy to defend what you've worked so hard to earn. So let's dive right in. It's so easy to feel like a genius when the market's just going straight up, right? Every stock you pick seems to work out, the portfolio just keeps climbing. But as this quote nails perfectly, real long-term success isn't built on luck. The thing that truly separates the amateurs from the pros is risk management. It's all about how you handle the downturns that are bound to happen. That's the real core of what we're getting into today. I mean, this slide really says it all, doesn't it? Just look at these names. These were giants, household names that felt absolutely invincible. Pillars of the economy. This is the ultimate proof against that blind buy and hold forever no matter what strategy. Without an exit plan, without a lifeboat, even the biggest ships can go down, and they'll take your portfolio with them. And this right here, this is the fundamental mindset shift. Amateurs are always chasing the upside. They're hunting for that next 10-bagger. Professionals, they focus on preserving their capital. They've mastered the art of not losing. They get that avoiding one massive, catastrophic loss is way more important than hitting a dozen small winners. This idea is the key to surviving bear markets, and it's going to be our theme all the way through. So here's our game plan. We're going to kick things off with a big dilemma every investor faces. Then we'll start building out our defensive toolbox, starting with the absolute basics. From there, we'll get into using options for protection, look at some more advanced hedging plays, and then tie it all together with a routine you can use in any bear market. And we'll wrap up by really locking in that professional mindset on risk. All right, let's pop open the first tray of our risk management toolbox. These are the foundational tools, the ones you absolutely have to have. Think of these as the hammer, the screwdriver, and the wrench of your portfolio's defense. You've got to get these down cold before you even think about the fancier stuff. Okay, the first, and I'm going to say the most important line of defense you have, is position sizing. Before you even think about what to buy, you have to decide how much you're going to buy. Doing this right ensures that if you are completely, totally, catastrophically wrong on one idea, it doesn't wipe you out. It keeps you in the game so you can fight another day. No single trade should ever have the power to knock you out of the market for good. This is the question. This is what you have to ask yourself before every single trade you make. Is this the hill I'm willing to die on? Are you really so confident in this one idea that you'd risk the health of your entire portfolio on it? The answer, almost always, should be a firm no. Just asking this simple question forces discipline and stops you from getting way too carried away with any single position. Our next tool is the stop-loss order. This is your pre-planned exit. It's you deciding before you even get into the trade exactly how much you're willing to lose. Then, if the stock hits that price, the order kicks in automatically and sells your shares. The real beauty of this is that it rips emotion right out of the equation. There's no hoping, no praying for a comeback. It's just a clean, disciplined exit based on the rational plan you made when you were calm. Now, this slide points out a really important difference in thinking. Amateurs often talk about diversification, which, let's be honest, is basically just owning a bunch of different things and hoping some of them go up while the others go down. Professionals hedge, and that is a much more deliberate strategic action. Think of it like buying insurance for your house. You spend a small, known amount of money to protect a huge asset from a very specific threat. It's the difference between crossing your fingers and actively insuring against the worst-case scenario. So one really powerful way to hedge is by holding assets that are basically designed to zig when the market zags. Things like inverse ETFs, or sometimes commodities like gold, can act as a fantastic counterbalance. The goal here isn't just to lose less money when things get rough. It's to have parts of your portfolio that are actually making money in that environment. That creates a much, much smoother ride overall. All right, time to open the next tray in our toolbox. Now, I know for a lot of people, the word options just screams high-risk speculation, but we're about to challenge that whole idea. We're going to show you how options can actually be some of the most powerful defensive tools you can possibly have. I want you to just pause and really think about this for a second. The common story we all hear is that options are super complex and just plain dangerous. But is that really the whole picture? Or what if that's just a big misunderstanding of what they're truly for? The answer is a big fat no. In fact, for some of the smartest investors on the planet, options aren't used to crank up the risk at all. They use them almost entirely to reduce it. When you use them the right way, they become an insurance policy for your portfolio. Let's dig into exactly how that works. And that brings us to a key strategy, the protective put. It's simple. If you own a stock, you're long that stock. A put option gives you the right to sell a stock at a certain price. So by buying a put on a stock you already own, you're literally buying an insurance policy. It sets a minimum sale price, a floor, and protects you from anything worse happening below that level. So let's break it down step by step. Imagine you own 100 shares of a company you love for the long term, but maybe you're getting nervous about an earnings report or just the market in general. Instead of selling the stock and maybe missing out on a recovery, you just buy one put option contract, which covers your 100 shares. Boom. For the entire life of that option, your downside is completely locked in. You've just successfully insured your position against a nasty drop. Okay, now let's look at the actual numbers. Let's say you own 100 shares at $100 a share. You go out and buy a put with a $90 strike price, and it costs you $200. Now, watch what happens. If the stock falls to 90, your unprotected position is worth $9 grand. With the put, it's worth $8,800. But look what happens when the stock drops to 80. The unprotected value plummets to $8,000. But your protected value? It stays put at $8,800. What if it drops to 70? Your value is still $8,800. That put has created a rock-solid floor. This is real, tangible portfolio protection. Okay, we've nailed the basic hand tools. Now let's head over to the garage and check out some of the power tools. These are more advanced strategies that actually combine the concepts we've just learned to build even more sophisticated and, frankly, more efficient ways to manage your risk. And our first power tool is the collar. As you can see right here, it's a strategy that builds directly on what we just did. A collar is basically a combo of 3 simple pieces: the stock you own, the protective put we just talked about, and one new piece, something called a covered call. Now here is the absolute genius of the collar. Remember how we had to pay a little bit of money, a premium, for our protective put, just like any insurance policy? Well, with a collar, we find a way to pay for that insurance by selling a call option. See, selling a call generates income, and the goal, a lot of the time, is to have that income completely cancel out the cost of the put. You're basically trying to create zero-cost insurance for your stock. You get all that downside protection without the upfront cost. And hey, that's not just me saying it. This is a direct quote from a trader with decades of experience talking about the collar. Now, the trade-off, because there's always one, is that you cap your potential upside. But if your number one goal is just preserving your capital, not squeezing out every last penny of profit, the collar is an unbelievably powerful and conservative tool to have ready to go. You know, not all defensive moves are just about protecting what you own. Some tools can actually be used to make money in a flat or even a falling market. A bear call spread is a perfect example. It's basically a bet that a stock's price is going to stay below a certain level. You sell a call to collect some cash up front, and then you buy another, cheaper call at a higher price just for protection. What you're left with is a position where you get paid to put it on, and your maximum risk is defined from the very start. So how do you find good stocks for a bearish trade like that? Well, you use a system, like the 4 pillars here. First, fundamentals. You look for a weak or way overvalued company, maybe one with a PEG ratio over 3, meaning its stock price has gotten way ahead of its earnings. Second, technicals. You want to see a chart that's already in a clear downtrend. Third, cash flow. You need to understand exactly how the trade makes money, from the price falling or just time passing. And fourth, risk. Your maximum profit and loss are crystal clear before you even click the buy button. This is how you turn a wild guess into a structured professional trade. Okay, so we've filled up our toolbox with some really powerful defensive strategies. But, you know, just having the tools isn't enough. You gotta know when and how to actually use them. So this section is where we shift from the what to the how, by laying out a clear routine for navigating those really tough markets. Look, a chaotic market causes panic. It makes us make emotional, bad decisions. The best way to fight that is with a calm 3-step plan. Step 1, you perform triage on your existing positions. Stop the bleeding. Step 2, once the immediate danger is handled, you can start looking for new defensive opportunities. And step 3, every so often, you step back and review your entire long-term investment plan. This is how you turn panic into a proactive process. So step 1 is triage. I want you to think like an ER doctor here. You have to deal with the most critical injuries first. You have to stop the bleeding. In portfolio terms, that means looking at your biggest losers right away. Is the position size still right? Are your stop losses where they need to be? And for those core long-term holdings you really want to keep, this is the exact moment you deploy those hedges we talked about, the protective puts or the collars that lock down the risk. We've covered the tools, we've covered the routine. Now let's wrap this all up by zooming out to the single most important thing of all, the professional mindset. Because at the end of the day, it all comes down to understanding what you can control and what you can't. Let's be real. You can't control what a company's next earnings report is going to be. You can't control what the Fed does with interest rates. You can't control how a stock's price is going to move tomorrow morning. All of that stuff is totally outside of your control. But you have 100% control over which strategies you choose to use. And most importantly, you have absolute, total control over your own risk management. You choose your position size. You choose where to set a stop loss. You choose to buy a hedge. This image just captures the whole idea perfectly. The market is the ocean. It's unpredictable, it's powerful. We can't control the storm, but we have total control over whether or not we get on the ship with a lifeboat. Your risk management plan, your exit strategies, that is your lifeboat. And you have to make the choice to build it before you see the iceberg. So I'm going to leave you with this one final thought. Take a really honest look at your own approach to investing. Is it built on hope? Are you just hoping things will go up? Or are you actively and systematically building a robust portfolio, one that comes complete with a plan for every scenario and a full toolbox of defensive strategies ready to go? The answer to that question really is what will determine your success in the long run.